Welcome to this virtual lecture in our introduction to banking. Last time we spoke, we talked about liquidity risk, or actually we talked about credit risk before that, and now we have arrived at liquidity risk. And actually liquidity risk is one of the most important types of risk that can affect a bank. And the feature of liquidity risk is, the most defining feature is that actually everything else we've talked about so far has an indirect effect on the company's chances of survival. If you take market risk, if you take credit risk, they can all lead to financial losses. But actually the company can usually bolster those financial losses. It can survive the financial losses up to a certain point. But then if you have insufficient liquidity, you're facing bankruptcy and you might be forced to file for bankruptcy. So this is actually the one thing that cannot happen if you want to stay in the business. So insolvency, bankruptcy is triggered by your company's, your bank's inability to be able to meet your payment obligations, to pay your short-term bills. And the risk that you might face bankruptcy, that you might face illiquidity, this is what we mean by liquidity risk. This is the liquidity risk of a company. In contrast, when we are talking about assets in financial markets, the liquidity risk of a financial asset is the risk, the chance that liquidity changes. So be careful when talking about liquidity risk. It might be something else when switching from a company to a financial asset. But here we're talking about liquidity risk in the sense that this is the probability, the chance, the risk that you are not able to pay your short-term bills. So market price, credit risk will lead to losses. If you have too high losses, then you might also run out of liquidity, and then you have liquidity risk. Now, the liquidity of a company, if we want to define it in more detail, is usually understood as the company's ability to fulfill all due obligations at a given time. That is, you are able to pay the bills that need to be paid. And the company maintains the ability to settle short-term debts by retaining enough cash or short-term disposable assets, cash equivalents on your balance sheet. You have enough cash in your register. Now, the liquidity of the company is a basic prerequisite for any company for its continued existence in a free market. And illiquidity, coupled with the maturity of short-term liabilities, can happen both. New bills, too many bills, or too little liquidity, will result in the bankruptcy or in insolvency of your company. And if the bankruptcy application is not filed with the responsible bankruptcy court despite the lack of liquidity, this can fulfill the requirements of a criminal offense. This is the delay in filing for bankruptcy. In German it's Insolvenzverschleppung, and you might actually face a criminal charge. Now, what is liquidity risk? Again, we have to be careful when defining liquidity risk for companies and for a financial asset. Liquidity risk for a company is the risk that a company has insufficient liquid funds to settle all short-term liabilities. And liquidity risk can actually arise in the company in two ways. First, you might have an unexpectedly strong outflow of liquid assets, perhaps because you've made an investment, so that debt repayments due in the near future are questionable. On the other hand, even if you have enough cash and cash equivalents, and if they stay constant, it might be that for some reason some of your liabilities suddenly become due in the short term, so you need more liquidity. And if you cannot come up with this additional amount of liquidity, again, you have a liquidity risk. Also, expiring loans may not be extended or replaced by new loans, and the liquidity risk of a company is therefore often referred to as refinancing risk. Liquidity risk is of particular importance for banks. It's important for any company, any industrial company, but it's particularly important for banks. And why is that? Because banks have an inherently fragile funding structure. Banks rely on customer deposits, and customer deposits are short-term financing. However, most deposits usually remain on the bank's balance sheet for a longer time. So banks work with this. They manage their financing in the sense that they assume customer deposits to remain on the bank's balance sheet, let's say for a medium term, and then they do maturity transformation. They have short-term financing, they give out long-term loans, and because they are transforming the maturities of capital needs and capital that is available, they face the risk that if depositors run to a bank and massively withdraw their deposits, which they are entitled to. These are short-term deposits and they don't need to cancel their contracts. They can simply withdraw their money. So if you have a bank run, if all depositors run to your bank, then the bank will be bankrupt immediately because it does not have sufficient short-term liquidity. And bank runs represent a central research field in banking and empirical banking research. And they are also one of the main reasons for regulating banks, because banks are inherently unstable. They have an important function in a financial market and in the financial sector and in a general economy. And they always face liquidity risk. In contrast, for insurance companies, liquidity risk usually plays a rather insignificant role. Why is that? Because in standard P&C, property and casualty insurance company, you have a constant and steady inflow of premiums. All your customers pay their premium, and you don't have a sudden increase in claims. This might happen, for example, when you have a cluster risk. If you have insured houses and you have a hurricane, this might be a problem. But then again, you also have reinsurance for this. So you have a comparatively constant inflow of cash through the premium, and you cannot have massive withdrawals of cash. It might be that you have a so-called insurance run, which happens very infrequently. An insurance run is a scenario where all customers suddenly cancel their policies because they think the company is bankrupt. But why should you do that? For example, if you've insured your car or your bicycle with an insurance company, if you hear that this company has financial problems, would you go and cancel your insurance policy? Probably not. There is not, your car is still there, your bike is still there. It's not suddenly stolen just because your insurance company goes bankrupt. So insurance runs are very, very unlikely and very uncommon. And even if all the customers suddenly cancel their policies, the insurance company does not have so many claims. So an insurance run is not really a threat to an insurance company, and liquidity risk is not so important for insurance companies. However, they also do asset liability management, of course. So they need to make sure that they have enough liquidity, but it's not as difficult as, for example, in banking. Okay. The next type of risk I want to talk about is op risk, operational risk. So far all types of risk had in common that they had an exogenous cause of the risk, for example, an exchange rate changes, a market price changes, and those risks were related to the core business of the company, most importantly, credit risk, the lending business. However, losses can also arise from exogenous events on areas of a firm that do not belong to the core business, for example, simply its IT system, or might have an endogenous source of risk. Your own employees, internal processes, again, the own IT. And these sources of risk might cause a different type of risk. And when it comes to endogenous risk, it's actually quite interesting to dwell deeper into this. And if you're interested in this, I can only recommend you the blogs and the works by Jon Danielsson from the London School of Economics on endogenous risk. He has a slightly different, probably more correct definition of endogenous risk. In this sense, it's endogenous because it's coming from inside the bank itself. Jon Danielsson has a better definition of endogenous risk. It means that you're causing the risk by engaging in risk management. And his best example for endogenous risk is, I guess, the Millennium Bridge in London, which became unstable after the millennium because people walking on the Millennium Bridge over the River Thames in London were trying to counter the movements of the bridge in strong winds. So because you are doing risk management and everyone's doing the same type of risk management, you're actually causing the bridge to become even more unstable. So that's his definition of endogenous risk. Now, especially in the first case, exogenous risks, natural catastrophes, unexpected major losses can occur if risk management has only monitored and controlled the risk in business-related processes, if you're not aware of any important risks that might affect non-core business segments. And these risks, in the past, were considered as a residual of the overall risk of a firm, and it's more precisely quantifiable risks such as market price risk or credit risk. In the mid-2000s, when we saw Basel II regulation from the BIS and the Basel Committee, the Basel II regulation started to define all these types of risk and to categorize them as so-called operational risk. And this is when the term op risk came into effect. And they also stipulated metrics and methods for measuring these risks, and capital adequacy became mandatory. Now, nowadays, this is included in the German solvency regulation, paragraph 269 Absatz 1 Solvabilitätsverordnung, and this is where you can now find a definition. It's the English definition or English translation of the German definition. Operational risk is the possibility of losses arising from inadequate or failing internal procedures and systems, people, or from external events, and this definition also includes legal risks. So this is op risk according to German regulators. Now be careful, for Solvency II, which is the equivalent of Basel II for insurance companies only 10 years later, the German Association of Insurance Companies, GDV, specifies this in the discussion paper Operationale Risiken unter Solvency II aus Sicht der deutschen Versicherungswirtschaft und Versicherungsaufsicht as following. It's German and English: reputational risk arising from strategic decisions and risks actively assumed in connection with insurance product are not covered by operational risk. So you can see that actually they make a distinction between everything that is related to the insurance business and that you have actively accepted, and everything else, which then again becomes operational risk. Now, the most important difference to earlier concepts before Basel II and before Solvency II of this definition is that it's no longer based on a residual value. So it's not simply defined as everything else in addition to market risk and credit risk, but it includes an explicit list of most important causes. So external events, people, procedures, failing procedures and systems, etc. Therefore, the general business risk, reputational risk, and sometimes I know that the definition in the solvency regulation states that this includes legal risk, but some people actually exclude legal risks. General business risk, reputational risk, and or maybe legal risk do not count as operational risks. And then what are the characteristics of op risk? They have a high level of loss. They have a very low likelihood to happen, and thus in combination they are very difficult to measure. For example, the probability that an asteroid hits your company building. If the asteroid hits your building, you have probably a very high loss, but it's also very unlikely. So it's very difficult to measure and very difficult to come up with an adequate capital metric. One example for op risk, the fall of Barings Bank. I've already talked about this in the financial risk management class. This is a prime example in which actually famous and prestigious investment bank in the United Kingdom went bankrupt overnight. And what happened is one single trader kept two separate accounts. He kept the profits in one account and the losses in the other account. And then what happened is he couldn't hide his losses any longer when the Great Hanshin earthquake in Kobe happened. And because of the earthquake, Asian markets went down, and so he was no longer able to hide his account with all the losses. And the bank actually went bankrupt because I think he had piled up losses of almost 1.2 or 1.3 billion euros, and the bank was bankrupt. So you had the interaction of various risk factors. The lack or failure of internal control procedures. No one checked this single trader. Also, illegal behavior of a single person, and then an external event. So many things that happened in combination. Okay, so these were the most important risk types. There's a typo here. Types with one S. And let's now talk about risk measurement. Risk measurement with the loss distributions. Usually in financial risk management, we are using P&L distributions. Financial risks are measured with loss distributions. And it means that P&L, profit and loss distributions, are modeled using statistical distributions and distributional models. And why is that? Well, the view that the loss distribution of a portfolio or a single risk position and key statistics thereof is sufficient to adequately depict the risk of such an investment can be explained by using several arguments. First of all, we are focused on losses. We are not interested in sensitivity so much. In the end, we are concerned about financial losses. So let's do this and measure our financial losses using loss distributions. Those certain moments, like the expected value, quantiles, they provide us with monetary metrics, and we can work with these metrics much better than, for example, with percentages, sensitivities. The loss distributions can be grouped, at least theoretically. They can be aggregated at the individual investment level, at the portfolio level, at the company level, and this is, of course, desirable in risk management. We can model netting and diversification effects, and last but not least, we can compare different loss distributions of different investments. However, the use of loss distributions also has two main disadvantages. First, they can only be estimated on the basis of historical values, and if the stochastic distribution law, according to which prices on financial markets develop, if this distribution law changes, the estimated loss distribution can provide incorrect forecasts. In addition, risk measurement with the help of loss distributions involves a large model risk. We can select the wrong type of risk mapping. We can forget some important risk factors. We might have the incorrect distributional assumption for a risk factor, and in the end we are choosing the wrong model. However, both arguments against the use of loss distributions only demonstrate the need for precise modeling and keeping in mind that you are facing model risk. Now, the use of loss distributions for measuring risk is not yet sufficient to make risks in a company manageable. We have our loss distribution, we have our model, and then we need to decide what to do with our risk model. We need to calculate key statistics, moments, single values of the loss distribution, and this creates the problem that we might have different possibilities to measure risk. And for a discussion of this theory of risk measures, you can have a look at the lecture on financial risk management. But again, we need to decide which metrics, which moments of the distribution to use. For example, we can use the average loss, the expected value. We can use the variance or the volatility of the losses. We can also use the maximum loss. However, all these proposed statistics and moments have some serious disadvantages. For example, variance volatility are non-negative, and thus they don't really show risk. If you only have profits and you have changing profits, you have some variability in your profits, but you don't even face a financial loss. So variance volatility will be positive and you don't really have a risk. The maximum loss is probably too extreme, and together with the expected value, they are not robust against extreme outliers. And thus they are too pessimistic, whereas, for example, the expected loss is probably too optimistic. And thus one shouldn't really use these metrics. What is used in practice is undoubtedly the most common risk measure, which is valued risk, the VaR. Now, it became effective in the early 2000s, mid-2000s, with Grundsatz 1 supervisory law, allowing German credit institutions, German banks, to use valued risk for their internal bank management purposes to calculate regulatory capital. Since then, similar regulations have been incorporated into the solvency regulation, was a huge part of Basel II, Basel III also, and it has become industry standard. Why is that? Well, actually, in the late 90s, I think, JP Morgan introduced a computer program called Creditmetrics. And as part of Creditmetrics, Creditmetrics gave banks the possibility to calculate the valued risk. This is where the name came from. And because all the banks were using Creditmetrics, or most of them, it became an industry standard. And regulators later on said, okay, if everyone's using it anyway, let's make it official. Let's make it mandatory for banks to use VaR in their internal models. From a theoretical point of view, VaR is quite problematic because it's not coherent. If you want to know more about this, have a look at the financial risk management class. Now, what is the valued risk? This is a rather complicated definition, I guess, of the probability, of the loss distribution. We don't actually need this, and we don't need the fine, correct definition. It's simply a quantile. It's the alpha percent quantile of the loss distribution, or the P&L. So if this is your loss distribution or your P&L, and this is the alpha percent quantile, here the cursor, let's say you have alpha percent probability here and 1 minus alpha here, then this is the point, the quantile, the alpha percent quantile, and this is the alpha percent valued risk. So it separates alpha and 1 minus alpha percent probability mass. That's what happens here. Okay. So that's the definition. In practice, the confidence levels, if you have a loss distribution, you need to look at the right side. Confidence levels are usually chosen to be 99 or 99.5%. They started out at 95%, but they've moved on to higher confidence level. And the time horizon for your distribution is usually 10 days in market price risk management, and in credit risk it's usually 1 year, because you also have 1 year credit ratings. Now, by definition, valued risk does not allow any information or any conclusions about the amount of losses that are likely to occur with probability 1 minus alpha. So you don't have any clue about the extreme losses. As an alternative, one could also use the so-called mean VaR, which is defined as VaR alpha minus the expected loss. But from a statistical point of view, it's simply a quantile. It's nothing but a quantile of the loss distribution. Now, this is a practical example. In 2017, here you can see the development of the valued risk by risk types in the annual report of Deutsche Bank, and you can see the different VaRs for interest rate risk, credit spread risk, equity risk, commodity risk, etc. And you see it changes over time, and it is given in millions of euros per day. Okay, so this is the VaR. Again, a serious disadvantage of valued risk is that it's generally not sub-additive, it's not coherent, and sub-additivity means that for two individual risks, we would expect that if you combine those two risks, that the risk metric, your measurement for the portfolio, is smaller or equal to the sum of the individual risks, so that you have diversification being reflected in your risk measurement. And valued risk is not generally sub-additive, meaning that it can happen that actually for a portfolio which is diversified, the overall value of risk for the portfolio is actually higher than the sum of the individual VaRs, and this is not intuitive. And thus a coherent risk measure is a sub-additive, positive, homogeneous, monotonous risk measure, and because valued risk is lacking sub-additivity in many cases, it's not coherent. Okay. Now, how can we extend valued risk? We can calculate the expected shortfall. Now, the disadvantages of VaR, missing sub-additivity, no estimation of so-called tail risk, that is the possible losses beyond VaR, have led to the search for alternatives. And one such alternative is ES, the expected shortfall. Again, this is the correct definition. We can actually move on. This is the case for a loss distribution for a given. It can be seen as a mean VaR, but actually this is the definition we are most interested in. This is my cursor. If this is your loss distribution and this is VaR, then expected shortfall is simply the average of those losses that lie beyond VaR. So expected shortfall alpha is the expected value of the losses given that the losses exceed the valued risk. So it's a conditional expected value, ein bedingter Erwartungswert, of those losses that exceed VaR. Very simple. This is the most common definition when you have a continuous distribution. This is the definition if you don't know if it's a continuous distribution. Also wenn Sie sich nicht sicher sind, ob das eine stetige Verteilung mit endlichem Erwartungswert ist, dann brauchen Sie diese feine Definition. Aber Sie sehen schon, das ist im Grunde genommen nichts anderes als ein gemittelter, bedingter Erwartungswert und in dem Fall, ne, ob stetig oder diskret, Sie nehmen da das Integral über die Quantile und damit kommen Sie dann letztlich auf das Gleiche, wenn es eine stetige Verteilung mit endlichem Erwartungswert ist. Also, this is the most common definition, and this gives you an economic intuition what expected shortfall is. It's simply the average of those losses that are even worse than the valued risk. Now, one advantage of expected shortfall is that it's coherent, it's sub-additive, and VaR is only coherent for elliptical distributions, normal, students' t distribution. Expected shortfall is always coherent. This is a nice feature. Okay. Now, expected shortfall has become more and more important in recent years due to Solvency II and Basel III regulation. As a reaction to the financial crisis, regulators have required banks to calculate and to measure tail risk more and more, and they are asking for expected shortfall. Now, if you have done this as a bank, you need to check whether your model was adequate, and you can do this by backtesting. So we've now seen two important and very commonly used risk measures. And if, for example, risk measures are regularly used in a bank, for example, for trading purposes, you get a constantly growing time series of historical VaR or expected shortfall estimates. And then you need to check whether your estimates were correct. And this process of quality assessment of a model is called backtesting. You're using historical data to check the validity of your VaR or ES model. And you're doing this by comparing your valued risk or expected shortfall estimates with actual realized losses. Now, there are several standard tests for VaR backtesting. For example, the Christoffersen-Pelletier test, the Kupitz test, K-U-P-I-E-C. And the basic idea of all these backtests is to have an indicator variable of VaR violations. For example, if you have a look at this here, and you know that actual losses in this case, where's here? Actual losses are actually here. You can see that you have some VaR violations here. You don't have them here. Again, you have a VaR violation here. and you get a time series of VAR violations. For example, this might look like 1, 1, 1, 1, 1, 1, 1, 1, 1, and then 0, 0, 0, 0, 0, 0, 0, 0, and 1, 1. And these are the VAR violations, and you need to use this time series of VAR violations, this indicator variable, to perform your backtesting. And this, if the VAR model is correct, this should be binomially distributed with probability 1 minus alpha. And you check for the correct number of VAR violations and for the randomness of the VAR violations over time. And these are the Coupe's test, the Christoffersen-Pelletier test. Some colleagues of mine, we also proposed one back test in the Journal of Banking and Finance. And you can use this to check the validity of your valued risk model. Now, this is risk measurement. We now have an idea of what risk types we have. We now know which metrics to use. The question now is, what can we do about risk most commonly? And what we do is we use hedging. We use financial derivatives most of the time, and we try to limit our risk exposure. In addition to hedging, what can we do? We can first of all avoid risk all over. The most basic strategy is simply to say, no, you're not getting a loan. Then you're avoiding a risk completely. So it means in the context of a bank that you, for example, in proprietary trading, you do not carry out a securities transaction, you do not grant a loan, and for operational risk, this is often not possible because you cannot simply say, okay, I'm not using IT system. Yeah, you need the IT system to run your business. So for op risk, risk avoidance is very often not really possible. Then you can do risk diversification. You can invest in different assets. For example, in credit risk management, you can grant loans whose probability of default are stochastically independent of each other as possible. In market risk, you can try to consider correlations. You can use simple portfolio management strategies. For op risk, this is probably not possible. How should you diversify the risk that you have a fire hazard in your company or that your IT system breaks down? You can also try to transfer or sell your risk. In credit risk, for example, you can sell or assign receivables. You can securitize your loan portfolio. You can use a credit default swap. In this case, you're simply transferring risk. For market risk, you can close open positions, for example, by selling securities. And for operational risk, you can buy insurance. If you buy insurance, you simply transfer the risk to the insurance company and you're done. Then you can reduce or limit risk. How is this done? Well, you can, for example, install a limit system. You can limit the amount of credit lines granted. In order to reduce market risk, you may enter into an offsetting transaction, a hedged transaction. And this is what we'll be looking at in just a bit. And you can limit your traders. Again, you can use financial derivatives. And this is the most common strategy actually in trading and market risk. So this is why we are looking at hedging in more detail. You should know what a financial derivative is. You should check this out and look this up, what a financial derivative is and what a simple call and a simple put is. Now, in this scenario, we are doing a 1-to-1 put hedge. So we have an asset position of N securities of an underlying, and we are buying the same number of puts on the same underlying. And thus the value of the combined position is then equal to, we have ST, the value of the stock, plus the value of the put, minus the initial price of the put at 0. And ST plus PT, the value of the put, we need to substitute PT using the payout profile of the put option. And this, for a simple put is the maximum of the strike minus the final stock price, or 0 plus the initial, sorry, this is a typo. This needs to be minus P0. This needs to be minus, because we have to pay the put. And this gives us X minus P0 or ST minus P0, depending on where the final underlying price is, whether it's below or above the strike. So the value function is, we have the stock. If the stock increases by 1, our position increases by 1, a very linear, it's a linear position. The put option, German Verkaufsoption, has this payout profile, and you can see that in contrast to the simple stock, we are moving down a little bit, so this is the price we have to pay. But as you can see here, we are actually bounding our losses at the level X minus P0. Okay. Now, the profit function then looks like this. Based on the fact that we have to buy the underlying. So this is actually the same plot as the one-to-one put hedge here. Just everything goes down by S0. You know, if we have to buy S0, then we need we have a loss of S0 if the stock becomes worthless. Okay. The one-to-one put hedge leads to an asymmetrical gain-loss position at the end of the term. So we are hedged against price losses, but we also have to give up a small part of our participation in price gains, in appreciations, in profits. If we have alternative strike prices, we have a trade-off between increased hedging against price losses and reduced participation in price gains. And with a one-to-one put hedge, we can also hedging can also take place during the term. For this, we would need American put options in contrast to European put options. Now, what are some requirements? What are the premises of the put hedge? Well, corresponding puts must be available. If you have, for example, the stock of BMW as an underlying and you want to hedge against price changes, then you need a corresponding put option on the stock of BMW. Otherwise, you get what we call cross-hedge risk. If the hedging horizon is capital T, puts with at least the same term must be available. Again, the availability of derivatives is crucial. And you need to check position restrictions and exercise limits. Why? Again, there's a typo here, exercise. You need to keep in mind that financial derivatives can be dangerous and they can expose you to high loss potentials. Thus, regulators are very concerned about piling up too many financial derivatives. And if you cannot engage in such strong derivatives trading, this might be a restriction. Last but not least, you can simply accept risk. If you think you can bear a certain residual risk, and this is happening all the time if you're in lending, you simply accept the residual risk. And if necessary, the rising risk can be borne by adequately depositing them with own funds, by checking that you have enough capital. If you have enough equity, not so much regulatory capital, of course this is important for regulators, but economically, financially, in the end, if you bear a loss, if you take a loss, then equity decreases. First your profits decrease and then you have to account for equity. Thus, you can simply accept those risks. Okay, so this was our lecture on liquidity risk, operational risk, risk measurement, and simple hedging strategies. If you're interested in this in more detail, please check the lecture on financial risk management. Thank you.